Simon, a very, very warm welcome, very, to the final podcast for the year, monthly market update, and it's been dismal. We're 12% down, total returns. So total return, and I actually forgot to clarify in our previous podcast. We look at total return, and that's really when you take the price, dividends, and other benefits that come with the performance of the index. That's total return. And usually people like to look at price return. So if you're looking at price return for the JSE All Share, it's been down 13.1% for the year, actually closer to 13.2%. And then total return down 12.1%.
So 12 is not a bad number, Danae. Look, it's not a nice number, don't get me wrong. No one likes negative numbers. But, 12% down is not a bad number, except that it comes in the back of 4 years of zero.
Yes.
And that then makes it a very, very horrid number. And that's the point, is that a lot of people, myself included, came into 2018, frankly, a little bit optimistic. The new leadership in the ANC, therefore new leadership in the country.
Ramaphoria wave.
Absolutely. The drought was easing.
Rand strength.
We had 4 years of sideways market. We could now get some upside to get those valuations, winding up and the like. And instead we got hit with 12% down and load shedding. And it just, it's like a hammer to the head. So,
And an interest rate hike.
And an interest rate hike. I mean, the only good news is petrol went down today. But
yeah.
but it really is, and I think it's partly that. Whereas if you've come into this market in the last 5 years, you got no return and you could grit your teeth and bear it. And then you just got, whilst you were gritting your teeth and bearing it, someone kicked you in the back of the head. In and of itself, if we had 4 years of 12% up a year and we had 50% up over the period, and now we're down, we're still ahead.
Yeah,
we're not. And it feels like it's just been a very, very bleak year. And if you look at a number of the darling stocks who've capitulated, MTN again. Naspers under pressure, thank you, Tencent. Aspen, Mediclinic. I mean, the list just goes on and on and on. And of course, we're recording today on the 5th, which this time last year, Steinhoff was a 50 Rand share.
Yeah.
Now it's $1.80. So
a lot has happened.
So truthfully, you might look at your portfolio and wish for only 12% down. That's the ETF holder. The person, depending what your portfolio looked like, it could be a lot worse. And maybe you went offshore and bought the FANGs, in which case you're worse than 12% down, because they were all 20% off or more. It's been a battering of a year.
So actually, I wanted to, because last night, as I was closing up shop here, and I looked at the US markets, and the Dow Jones was tanking once again, which seems to be happening a lot. There's like a day where there's a ridiculous sell-off, and then there's like recovery, and then there's another sell-off, and it's just, these sell-offs just seem to be happening more and more frequently. And I'm just like, I'm not even sure if it signals anything, but it's concerning.
So, the Dow Jones. So interesting but useless stat. There's only been 5 years in the last 50 where there's been a 3% down day in December, and that was 87, 98, 00, and 08. Nice, useless, but I love random useless stats like that. So to me, it's really quite simple. The US markets, Dow, Nasdaq, S&P, pick your market, are currently heading for bear market territory. They're all about 10% off their highs and another 10% down, and they're in the bear market. And this is not unexpected. This is what markets should do. Of course, the US markets haven't done a 20% pullback since the 08-09 crisis. When they bottomed in March 09, they've had some 5s, they've had a few 10s, they've had no 20s. We should have a 20% pullback every 3 to 5 years. So we due a couple. Being led, as I said, by the FANGs, there has been some rotation into other stocks out there, which is so that the FANGs haven't, they're off more than 20, and even with their weighting in the index, we're doing okay. What has surprised me is I've been watching the US 10-year Treasury, and I thought that at 3.5 was going to be the bellwether of doom and gloom, and it's at 2.92. It got to 3.2 and some change, and it has now strengthened. simply, why are we seeing, and it's the volatility. So if we look at 2017, or was it 16? I think it was 17, was one of the lowest volatile years in terms of volatility in the US. There were weeks and weeks on an end where it was just 1% a day. There was no serious volatility. And I think it was Trump's trade wars. At the G20 in Venezuela, Argentina over the weekend, he met with Xi and they talked, and he said trade peace in our time. The market believed him on Monday, but by Tuesday had stopped believing. And there's two reasons why the market stopped believing. One is that what he told us was just overly vague. He said a 90-day extension on putting up 25% tariffs instead of 10%.
Yes.
And China has agreed to buy a lot more US product.
That's not very specific.
No T's and C's. No T's and C's whatsoever. And I think the sense is that this is going to continue for a while and could still get ugly. He seems, I think it was Paul Krugman in the New York Times writing, saying that he just seems not to understand that actually tariffs are a tax on the American consumer, not the Chinese consumer. It hurts the Chinese because they sell less.
Yes, yeah.
But you sell steel with a 25% tariff. It costs 25% more
for the
to the
person
US.
getting it.
Yeah. So China might sell less steel as a result, and maybe some South African steel sneaks in or something. But it's just, we're used to politicians. We're used to not liking them. We're used to them being creatures that we kind of, we need, different debate, but we need politicians. But here we have one who just rides roughshod, and you don't know until the next tweet what's going to happen. So I think that has spooked the market, coupled with high valuations, coupled with a massively strong run. I think bear markets, which takes the S&P and Nasdaq off another 10% each, maybe during Jan and Feb. I do think that China and the US will find some trade peace in our time eventually. They did it with NAFTA. That is Trump's style very much, and some cool heads will prevail, and then we can start to positive returns again in 2019. Quick last point on US markets. Don't expect the level of returns you've seen in previous years. The market has got well above the average. Reversion to the mean means we'll have some below average returns over the next 3 to 5 years out of S&P in dollar.
Okay, and perhaps now bringing it back home, Viceroy?
Yeah, Viceroy.
Back in the headlights?
Back in the headlights.
In trouble with the German government? That's never a good sign.
And our governor of the Reserve Bank.
Yes, who really doesn't like them.
No, he does not.
But NEPI, their latest target.
NEPI, the latest target, the resilient stable was certainly back at the beginning of the year. There were concerns. It was resilient Green Bay, Fortress A and B, and NEPI Rockcastle. There was thought that maybe they or Aspen would be the target. None of them were. Of course,
although Aspen did still.
Yeah, I can't help thinking that part of what we as a market, I use the raw we, did in the fear before and remember December, January, Viceroy report coming, paranoia. What we did is we basically gave Viceroy a list.
Yeah,
because they like
of concerns.
So which are the stocks that South Africans are selling off? Those are the stocks that they have concerns. Let's go do some digging.
Yeah.
Aspen did it itself.
Yes. So Aspen, definitely wasn't a product of Viceroy. It was.
Initially it was, and truthfully it was well off its highs already.
Yeah.
But NEPI Rockcastle, the report which I have read and didn't understand enough of to be able to enlightenedly comment on it. My understanding of IFRS in South Africa is scant enough, never mind GARP in Romania, which is what they use, generally accepted accounting practices.
Which is, a US.
Yeah, a strong rebuttal from NEPI. I read their rebuttal. I listened to their conference call. Certainly they're coming across guns blazing. And at the end of the day, not sure. With Steinhoff, we absolutely knew who was right, and it was Viceroy. With Capitec, it wasn't new information, and you had to make a decision. You should know about that information,
and if you don't,
and you had already decided yourself whether you were comfortable with it or not.
Not.
Yeah, I honestly don't know. But there is one thing that does to me, it's red flags. Is a lot of the Nepi Rockcastle investments are joint ventures, and the reason why a joint venture is a red flag is not because a joint venture is
in
anything,
and of itself.
Yeah, but it is where you hide things off balance sheet, and Steinhoff, if nothing, taught us that. So if there are skeletons, they're hiding them. But are there skeletons? Honestly, I don't know. I mean, I'm not sure, and truthfully, neither does Viceroy know either. I mean, the only people who truly probably know are some of the board members at Nepi, and if Steinhoff tells us anything, if there are, not even all the board members. So it's a really, really tough call to try and make. And my sense is at this point, folks were saying, is it cheap? Should I be buying? And my sense is no.
You don't know.
You just don't know. Let's let some dust settle. And I see Resilient has agreed to an independent forensic report. This process is still to roll. And yes, there's valuations. But much as the people who a year ago thought that Steinhoff at 40 was cheap, and I'm not saying Nepi Steinhoff, I'm just saying we don't know. And not knowing, to me, is a simple response. Do nothing.
Do nothing.
Yeah.
Go wait and see.
Yeah.
And perhaps topic of interest as well, currently Tiger Brands, the first trickles of
the class actions.
Thank you. I forgot the word class action. Class action lawsuits are coming through, and seeing a lot of media buzz about covering the various. I mean, I've read articles about the various victims and their stories, and there's the business side of it, obviously, and then there's just the human element of how many lives were destroyed. And
234, I think, which is just a terrifying number.
So, I mean, of course, one likes to think that they've made provisions for these things, but what does this mean for them next year?
So I think Tiger's got a number of issues. So they have insurance for this. Whether insurance, and we haven't had insight to the policy. My question is that if it is found that Tiger was negligent or something, what does that do to their insurance policy? Honestly, I don't know. Tiger is certainly implying, no worries, we have insurance.
We've got this.
We've got this. It did, however, in their last set of results, we saw cost them some 900 million. Part of that money was in the cleanup process, part of it in lost sales, all of that. So 900 million, which is very, very significant.
Yes.
But Tiger has some bigger issues. One is a potential impending drought coming through next year.
Which actually we did a webinar on, and we're sort of on the fence about whether or not it will.
Yeah, so the Japanese and Australians are saying a 70% chance, and I can't find hard data for us, but certainly there is a chance, and it's not expected as severe as the previous drought we just came out of. It won't impact the Western Cape. It's going to be Gauteng, KwaZulu-Natal. But that won't be lacquer for Tiger Brands.
Yeah.
There is, however, to my mind, a bigger, longer-term issue that they have. And that is their consumer products, ginger biscuits and the like, are typically number 1 or 2 in the categories in which they operate. And that has been, Tiger Brands, hence the name. The trick is there's been a lot of shopping down. The ginger biscuits are nice, but money's tight. So you went and bought the no-name brands, and you know what? They were ginger biscuits too. And maybe they're not quite the same if you're a connoisseur.
But they're ginger biscuits.
And we have white label penetration in this market at about 15%. Other mature markets are closer at 30%. I worry that they've got more losses in terms of their traditional brands. Not losses, erosion of market share coming their direction. I worry that they might not. You might buy the ginger biscuits for a special event, but for your normal watching rugby or soccer, you might just get the white labels.
So the one thing that I have noticed, and particularly with the bread, but they're doing a lot of price promo. So and that obviously might help them keep their market share, but what they're getting in then is not. So if you're cutting costs but volumes, it has like a null effect.
And it also has a risk on your top branded product that it's always being assumed as premium. But if you're now selling it on price rather than premium, you're selling it on both price and premium.
premium.
The consumer is not going to forget about the price scenario, and next time they go and they're back to normal. So I'm not sure if Tiger aren't just so the listeriosis is broadly through their results. They've got most of their markets open. They've got to get people are eating enterprise bologna again.
Yes.
The chap who sells me my quarters is like back to bologna, but he's not touching it. He uses Renown these days.
Okay.
And he said, you won't know the difference. I'm like, yeah, well, I won't get listeriosis. And the whole queue laughs.
I won't die.
Yeah, and everyone in the queue laughs, and that's their current problem. Can they get people eating it again? Can they keep their premium brands premium?
Yeah.
And we will see in time. The short answer for me is I never like food producers because they're always getting squeezed. They're getting squeezed with input costs, or they're getting squeezed by the retailer who says, we'll stock your biscuits, but I need it at a price point. You've got your price takers left, right, and centre, and that's not what you want to be. That's not an enviable position to be. And the share price is reflecting it. But even now, down in the 200s, 230s, I don't think it was a 280. I don't think it's cheap, but I don't think it's massive value.
Especially if the future's so uncertain.
Yeah, there's just too much unknown out there.
Okay, and I suppose looking forward into the year, what stocks what do you have your eye on, and where do you hope there'll be a difference? And I know for me, Woolworths is one of those where I'm like, oh my goodness, will it change in 2019?
Look, it changes at some time, although at the AGM they refused to discount the fact that they might have to write down more of David Jones. Having written already 7 billion on a purchase price of 21, is there more? So my broad view is I was looking for a stronger ZAR this year. We've got it by a few cents, but and I was looking for top 40 green. We haven't got that. I still think we're going to get. I'm still looking for a stronger ZAR, just because. Wayne McCurry and those sort of folks who know this sort of thing would tell you that fair value on the ZAR is around 12.50 to 14, which is a wide range, but nonetheless. And what you know about the ZAR is it goes out both sides. It'll go out the top, it'll go out the bottom. We've had the blowouts to the top repeatedly since Nene's first firing, and my sense is we need to and sub 12.50 over the next year or two, maybe 3 makes sense, maybe even sub 12. I think we've got more downside in the short term, as with the US. We can't escape that. Some point in Jan and Feb, we start to move again. An election next year means politicians are crazy as they try and keep their jobs until the election in May, and then they can go and back to Cape Town and vote on stuff.
And so fight in Parliament.
I'm cautiously optimistic for the South African market. The South African economy next year is going to be a tough place. Load shedding, interest rates, they're still low, but they're up. They've edged up. Our first increase in 2.5 years.
Yes.
I think our economy is going to find it very, very tough. I think we will get growth, but I think we'll be hard-pressed to do much above 1.5% GDP, which is, frankly, population growth, and therefore, as South Africans, we are better off. I am more optimistic to our market for a couple of points. Firstly, our market, top 40 is about 2/3 offshore in terms of their earning, beyond the borders of South Africa in terms of their earnings base. And the market is not the economy. We've learned that lesson the hard way many times. So I am cautiously optimistic for top 40. But I'm not, whereas if you'd asked me a year ago, I would have said, 18, 20%, easy. Man, if we can eke out 10 or 12 next year, I know, it is so depressing. But if we can eke out 10 or 12 next year, I think the US markets are probably going to eke out 6 or 8. Remembering I'm expecting us to sell off, so better from the troughs, because the sell off Jan Feb. But for the year to date, I'm expecting a little bit. I think we're going to start seeing a pullback on QE in Europe, for the largest reason that they need to start raising rates, because dropping rates is your best defense against a crisis, and you need that defense. The US will continue with the rate rising slowly, maybe pulling back a bit, but certainly there. I don't know what's going to happen with our rates. Our governor last time, I agree that you want to get ahead of the curve. So they're saying, look, you know what, there's oil, there's ZAR, there's risks
all
out
these
there.
Things.
But as the course of the year unwinds, and they basically said 3 more between now and the end of 2020, as the year unwinds and as we get into 2020, it might not be as bad as we anticipated. So we might only get 1. We might get none. We might only get 2. I touched on Eskom. Eskom's going to hurt. A lot of industry, retail, etc., has, where possible, gone off Eskom. In other words, the mines, the paper producers, the retail stores with their signs, we still operate during, but not all. And it's no fun at home. You know, I've got a pile of ironing that didn't get ironed because yesterday was ironing day and I didn't have power. So stocks I'm looking for. I'm focusing a little local. I like ShopRite, and I tell you, because we've got to eat. The beauty of ShopRite is we're always eating, and either you're shopping down from Woolies to ShopRite when times are tough, or when times are good, you're shopping up to ShopRite from Boxer and USave. So they're always kind of in that middle ground. They're tapping into the higher LSMs and taking on Woolies a bit. And what we saw was, 11,000 products with deflation. And their problem there is the product prices don't move, but their costs do. Staff, electricity, security, rental. We'll start getting some inflation coming through, I suspect, particularly if there's a drought. That will give them some margin going back. So I like ShopRite. City Lodge, interestingly.
Okay.
Well, it's cheap. They're at low levels, and I've always liked City Lodge, and I hold both of them. ShopRite and City Lodge in my portfolio already. What I like with City Lodge is they're a great business. They're great leverage. We went through a period of overcapacity. We've still got a lot of capacity for current demand, but elections drive demand at the low end. So the fancy oaks, the leaders, don't stay at the City Lodges. They go to the Hiltons. And the Westerns and the like. But the foot soldiers, so to speak, are moving around the country, doing elections, staying at City Lodges. And I happened to stay, I missed a flight a few weeks ago, so I stayed at one by the airport. And he's like, yeah, election years are great. I think that'll help, and that'll give them a fillip, which I think they can carry into just by a slightly improving economy into 19 and 20. And around the 130, City Lodge is looking attractive. It's a stock I've held for a long time. It's never going to shoot the lights out, but it's
steady.
Yeah, it's also a little volatile because of liquidity. I'm looking at property.
Okay.
I don't think we're going to see massive increases in terms of occupancies. In fact, probably none. I don't think we're going to see massive increases in terms of rentals. They're going to be very low, and oftentimes because you're trying to keep customers and the like. The point with property is it is cheap. If you speak to Kilian Ndlovu, head of listed property at Standard, he will say to you about the cheapest in 10 years. So sitting on a yield, if you look at the ETFs, of around 8 or 9%. And I go the ETF route here rather than individuals, which mean I have some of the resilient stable, but so be it. But just looking cheap, and I'm liking that cheapness to them. Whereas for 10 years they've been very expensive. They've been significant premiums to net asset value. They've had massive erosion in the yield because of the price appreciation. That's now all reversed. And then Coronation.
Okay, that is an interesting.
Yeah, so Coronation, well, look, so property, you're being paid 8 to 9% to hold the ETF while those property companies gather themselves together and start giving good returns again. Coronation, you've been paid 9% to hold it. Their headline earnings were down, their ORM was down, assets under management, their dividend was slightly down in the last set of results, all of it only a little bit. But they're sitting on a dividend yield of around 9%, which is way above what a bank pays to hold them. If you look at their market cap relative to their assets under management, they're a standard deviation below the average. Okay. And that average, to get to the average, gives them about a 50% uplift. I think in the mid to high 40s, they seem to have found a bottom. They seem to be sitting down, sitting solid there. They have had some of their funds underperforming, down in the third and in some cases fourth quartile. That's probably going to reverse. They've had some bad stock picks, Aspens, MTNs of the world, but you know,
but they're not alone.
But who hasn't? That's just a factor of the market, and I just think that. Again, it's they are one of the leaders in our managed asset space, in the active space in this market, and they're at a really, really attractive price. And two things: if they can sort of get back to their averages, and we get an uptick in the market, that uptick in the market, just bottom line, you know, they charge about 60 points at the end of the day, and if they pick up assets by 10%, well, their revenue just goes 10%.
Goes up, yeah.
If they outperform, it kicks out even more, so they win there. To me, they're just looking really, really cheap in that space. I mean, Signia is another, so is Anchor. Signia is making about 0.2% revenue because they were passive. I'm not as attracted to them. Anchor, issues galore. Coronation is my one there. And I like you know, it's what a 4.5 years of going nowhere market does to you. Suddenly someone says, look, he has 9% just to hold it. And it's like,
I guess I'll take it.
So some Coronation. And then I'm my last one is I'm looking at long and hard at Naspers, and here's why I'm looking long and hard at Naspers.
Yes, tell us, because
they're gonna spin you out multi-choice, and I think the Naspers share price won't even move. You'll get no multi-choice, and Naspers will drop 5 cents, which is a rounding error. And I know we all hate multi-choice, but look at those results. They are growing subscribers in the continent. Yes, premium subscribers, their average revenue per user is down. They're losing in the premium side. Is that because people hate them? No, it's because people are poor, because it's tough out there. I was on premium for years and years and years, and I got rid of it because the only reason to really pay for premium is sport. And I turned on to watch the cricket one day, and like my wife's like, no, we haven't had this stuff for like 4 months. Like, it'll been 4 months since I tried to watch anything. And it's like, so that's $4,000 wasted.
That you haven't.
Yeah. So I actually like multi-choice. They make about 5 billion profit. They're going to come out, say, market cap of between 50 to 60 billion.
Mm-hmm.
They'll be a nice dividend payer. Are they one day going the way of the dodo? Maybe. But they might also change their business model. And there we have Showmax and all the other bits and pieces. And I know everyone on Twitter hates Naspers and multi-choice and no longer is subscribing. The numbers say that you're all a bunch of liars. That's just what the numbers say. Or it says that actually Twitter is not a representation of the population as a whole.
I feel like it's probably the latter.
I know. Well, actually, I think it's a bit of both. And then so now multi-choice is out. You're going to get some multi-choices. You might want to sell them. You might want to keep them. It'll be your call. And then Tencent becomes the issue. And a couple of things. Tencent is looking again at listing their music division in New York. Mm-hmm. New York Stock Exchange. They had pulled that. That'll give them a nice fillip. What we also saw in their last set of numbers is that Tencent is more than gaming. Advertising revenue was suddenly huge. Micro loans or unsecured loans was suddenly huge. All their other bits, which I suspect the board was just like, make games, and when they couldn't, they were like, oh, well, let's do other things.
Give them money.
And gaming will return. So what happened was China said, look, you know what, these are bad for the youth. We need a process, and there was no process yet in place. There were some ad hoc ways of doing it, and then the authorities have now even shut down on the ad hoc ways. At some point, at some point there will be process. The games will come back, and they have some absolutely giant games. And they've got WeChat, which is outside of Facebook the biggest social network in the world. And WeChat is not WhatsApp. You can order your
it's a lot more.
Your cars, you can pay bills. It's a lot more than just a messaging app. And so I think that Tencent can probably start to pick up, and I think that will then help drag Naspers, and you'll get the spin out of multi-choice, which I don't think will impact price much, and then maybe a slight closing of that discount from the current 40 odd to probably a more realistic in time, 15 or 20% would probably be more realistic in time. So Naspers is my last one to really have the curveball out there.
Okay, I think that list is quite interesting. Some surprises, definitely City Lodge and Naspers.
Yeah, City Lodge is a nice sleeper to have in a portfolio, pun intended. And it really, because of that leverage impact, right? So you pay X to run a hotel, you get 10 extra guests and your costs go up 12 cents, but you charge those 10 bed nights. So as soon as an economy picks up, they really benefit. And in this case, an election while we're waiting for the economy. A little bit of Africa as well, not much. Kenya, Botswana, a bit here and there, but a very slow and cautious. And they own the land. So if you go to their balance sheet and you check how they value their land, and I haven't done it in a bit, but last time I checked, the value of their land, which is a conservative valuation, is about 45 Rand a share.
Okay. So no Airbnb monster coming for them?
No, so I mean Airbnb is real and people use it, but so Airbnb is my sense is very much more on the holiday maker. City Lodge very much more as the businessman. I spend 20, 30 nights in hotels a year. I don't use Airbnb. It's just I want that convenience. I want to check in where I just walk up, I say my name, they hand me a key, and I'm off to the races. Yeah. I don't want to so where do I find the key? How do I get it? Like, what about this? Does this? I mean, it's that level. So when I'm holidaying, I'm Airbnb. But Airbnb is also a weird one, and it's like Uber, and it's that supply and demand. If you look at the average Airbnb person in South Africa who's renting, they're making about 26,000 a year. That's a lot. But no, it's not. It's a little over 2,000 a month. I mean, there's that long tail. So I think a lot of people, and I know folks, my sister being one of them, who rushed into the Airbnb space and have gently crept out of it again. For different reasons. In her case, it was actually more viable to put a student in an 11-month contract than it was to manage the whole process and stuff. And she was making the same money for a whole lot more effort. So Airbnb, yeah, in time, but certainly here, City Lodge is very much more a business traveler's hotel.
Okay. All right, that's quite interesting. Simon, thank you very much. Have a lovely holiday.
I will. I'm so close.
And whether or not we get our Santa's rally remains to be seen. Highly unlikely.
I'm not betting on a Santa rally. It breaks my heart, but I'm not betting on a Santa rally.
But yeah, and let's hope 2019 is, at the very least, not a downward or sideways market.
I'll take single-digit return.
Yeah, we'll take that. Anything but what we've been getting this year and the other 4 years.
Yeah.
Because that's been...
We are literally back at March 2014 levels.
It's tragic. All right. Thank you.
Always a pleasure.